Well, good afternoon, everyone, and welcome to our weekly webinar where we will talk about what we see happening in the global economy and financial markets and how all of this impacts our decisions on the best courses of action for your portfolios. We're recording this so that those who can't join us live can tune in when it is more convenient. But I'm joined by my partner, Paul Tepsich, the founder of HighRock, and also on the call is our financial planner, Bianca Tomlinson. We'll have a Q&A period at the end of the call, so if anyone has a question about portfolios or any aspect of wealth management, please feel free to ask questions then. For those of you joining us for the first time, and Paul, I see that we've got another record number of participants today. HighRock was founded by Paul in 2010 to manage a series of mutual funds for Scotiabank, and we are, as a result, registered with the Ontario Securities Commission, which is an agency for the province of Ontario. For us, this is an important difference from a regular financial advisor who is only licensed by the Self-Regulating Investment Industry Regulatory Organization of Canada, more commonly known as IIROC. In essence, and more importantly for our clients, this holds us to a higher level of fiduciary responsibility. So earlier this year, after having managed $400 million in the client money over a number of years in my former situation at Turner Tomlinson, I sold my interest in that operation and joined Paul by purchasing half of HighRock so that Paul and I could work together to build a private client operation that was different and better. Now, of course, every financial advisor says that they are different and better, but we are not financial advisors, and that is the key. We are portfolio managers who have a clear understanding of wealth management. And for our clients, this means that we build your portfolio strategy based on your personal and family goals. And we develop a plan that will plan for you and develop a portfolio strategy that best suits that plan. The synergies and scale that we have with the fund management side of the business allows us to pass on the cost savings to our clients. In a low return world, this can add significant value to a portfolio over longer periods of time. Also, we not only report on a regular basis to the OSC, but we have something that no one else offers, and that's an independent review committee. And this independent review committee reports directly to our clients to ensure that we are doing everything that we say we are doing, putting our clients' interests ahead of our own. My reason for joining Paul was to offer something different and better, and not just to talk about it, but to do it. And we have that formula. Okay, so let's go back. Oh, sorry, Paul, do you want to jump in?
I was just going to add on the IRC. We don't need to have an IRC. We manage separately managed accounts for all of our private clients. Only public prospectus-based funds, like mutual funds, etc., need to have an IRC. We do not need to have one because we are not managing publicly based prospectus funds. We want to have one. We want our clients to know that there is a third-party compliance firm that is looking out for their best interests. So we're going above and beyond our regulatory requirement by doing this. And as Scott, you said, we're the only portfolio management company in the country managing private client funds on an SMA or separately managed account basis that has an IRC.
Exactly. Okay. Well, thanks for adding that in, because I think that really touches on a really key fundamental difference of what we're bringing to the table, and I think our clients need to and our prospective clients need to be fully aware of that. All right, so just continuing a little bit from where we were over the last couple of weeks with regards to talking about our different themes for 2015, and I think we'll just do a quick review of those. But one of the things that I started writing about, and I write my daily blog and talk about some of these themes on a fairly regular basis. But one of the themes that I began the year with was we would probably go through a year where we can expect the unexpected, and certainly up until now there's been a lot of that. Certainly the repercussions from falling oil prices and their impacts, certainly, especially on the Canadian economy. It forced the Bank of Canada to cut the bank rate. That was a surprise. Global economies in the first quarter, and more significantly, the U.S. economy experienced very significant slowdowns. And the fact that that was not expected certainly is in keeping with that theme. So what next? Well, what is expected going forward is that the U.S. is expected to lead the global economic recovery in the second half of 2015, and that the Federal Reserve will start to normalize interest rates in September. Now, central banks have been fighting deflation with all sorts of monetary stimulus over the since the beginning of the year, and one of the things that has been a key focus has been deflation. But a question that we can all start to begin to ask ourselves is inflation returning? Are there some growing expectations that we've seen deflation run its course, and are we starting to see inflation return? And one of the things we can do, and one of the things we do, is we take our cue from the bond markets. And we'll get into that momentarily, but certainly what have we been seeing from bond markets recently, and what can we take from that? And then finally, of course, one of our themes is that equity markets have been expensive, and we'll continue that discussion a little bit further along in the program today. So let's talk a little bit about bond market volatility. Bonds have been extremely volatile over the last month and a bit, and we thought we might just sort of have a look and see what's been going on. So bond yields have been rising, and especially since April 20th. So on a global scale, bond investors have decided that they want a greater inflation premium built in to the bond investments that they're making. And this is following all the central bank monetary stimulus, as I mentioned before, that was put in place to try to fight deflation. Well, if they're winning that fight, then the bond market participants are going to start to look beyond the current situation and look towards the future. And I think they're starting to sense that with all that stimulus, they want to get a little bit more protection. So, as I said, they're building in that inflation premium. Again, if this situation continues to develop, where inflation starts to return, central banks are going to have to, at some point, start to remove that stimulus. And we already saw what happened when the Federal Reserve even began to think about removing that stimulus when they started to discuss reducing their quantitative easing program, something that was commonly referred to as tapering back in 2013. Interestingly enough, if we look back at what happened in 2013, the prices in the anticipation or the expectations of this tapering, actually bond prices plummeted. But when the actual tapering occurred, bond prices actually had rallied back, and the actual tapering really didn't impact bond prices at all. And now that we're looking forward again, there may be more potential tapering from other central banks down the road, and I think bond investors are starting to look at the potential of what might occur. And I think as a result, starting to look at bond yields and say, this may not make so much sense if inflation starts to grow again. And often, as we've said on these calls, bond markets lead all other markets. So we're watching them very closely. Paul, did you want to throw anything in here?
Yeah, I do actually. And your chart there sort of shows it, but unfortunately I have another chart that I should have provided to you that shows effectively, and it just has the dates in. It's the same sort of chart. It's on a yield basis, but every time the Fed tapered after QE1, QE2, QE3, or the taper tantrum for QE3, bond prices went up, i.e. yields went down. So, again, expect the unexpected, buy the rumor, sell the fact. So I'd also just add that, it's been a hell of a bad month for government bonds around the globe, and they've weakened off so dramatically. Whether they're pricing in some inflation expectations or something else is yet to be seen. But today was especially this afternoon, a much, much stronger day for the government bond market. I quite frankly, my gut tells me that rates just moved up too far, too fast.
Well, let's just have a quick peek here at inflation, because interestingly enough, if we look at the Canadian situation, we have obviously actual inflation, which includes oil prices, has shown a decline until very recently. But the actual underlying core that the Bank of Canada tends to monitor, when you look at that, and we can expand this to a global situation, but when you have bond yields yielding less than the rate of inflation, your real returns are actually going to be negative. And if bond traders are starting to get nervous about these negative real returns, then there is some rationale behind why they've reacted to the degree that they have. Now, again, as you said, it is reactionary, and perhaps, as with most markets, gets overdone when this begins to happen. So, in essence, what bond investors have been doing is that they're being cautious, and they're selling at current prices, hoping that they'll be able to buy them back at lower prices and better yields, and that, in essence, will give them what they're looking for in inflation protection. Just again, with the Canadian situation, you can see here, as we said, over the last month and a bit, we've seen some extremely moves higher in yield, and quite honestly, it's quite something to monitor. As Paul was saying earlier, it's a very volatile situation that's evolved. So, technically speaking, if this channel that we're looking at on the chart does get broken out of to the upside, there may be potential for yields to rise even further, and that will have some significant impact on lending rates and mortgage rates, and potentially have some create some problems for the Canadian economy if that were the situation. So again, it's something that we have to monitor closely and make sure that we're keeping a close watch on this.
Scott, you may want to add to our clients that we have been waiting patiently, noticing that rates started climbing up over a month ago, and yesterday, just in fact, we did some purchasing of those 10-year Government of Canada bonds, in fact, which, as your chart shows, we're pretty close to the upper end of that technical channel point. So we did do a bit of buying yesterday for our client accounts.
Yeah, but and even more importantly, Paul, we are layering in as we do this. So it's not like we're all in here. We're just using our experience to say, okay, this is a potentially good buying opportunity. However, we'll keep some powder dry in case we get some better buying opportunities down the road.
Yeah, absolutely.
And speaking of opportunities, that leads us to talk a little bit now about equity markets. And one of the themes that we've been continually discussing on these calls is that we think that equity markets have gotten rather expensive. And just to continue with that and just reiterate, all of the central bank stimulus that's occurred have pushed interest rates to unprecedented lows, not now, but back in April. And German bond yields actually touched down close to zero, and they've recently bounced back. And when interest rates go down, investors can do two things. They start to sell securities that don't have great returns, and they'll increase their risk to buy securities that potentially promise greater returns. That may be a bit after the fact in some cases. Normally what happens is we see fairly significant buying as we get closer to the highs. In fact, most of the buying is done right at the highs. Well, another thing that we've actually seen happening as we push equity prices push themselves higher is that they've started to move away from the underlying fundamental, which is earnings. And earnings, the blue line on this chart, show us that they've been declining, or at best are flat to the earnings of a year ago. So earnings are not growing, but stock prices have been continuing to rise, and we think that is something that warrants caution, especially with regard to equity prices. So
hey, Scott.
Yep.
Scott, well, that chart would actually look even worse, I bet, because you're using earnings per share as the blue line, and given that the share count or the denominator is actually dropping because of large cap, especially in the U.S., large cap U.S. companies have been doing such massive buybacks that earnings per share actually looks better than, say, top line revenue or just net income. If you stripped out the per share data, it would probably look even worse, wouldn't it?
I would say you're right. But again, even the best case scenario shows equity prices as being expensive, and I think that's certainly all of the things that you just said have to be taken into consideration as well. All right. Lastly, just again another look at where we are, where we've come, and how far we've come from even just 2011. Still, again, maintaining that upward trend in equity prices. But over up and to the right on this chart, you'll see that we seem to have been bumping into a bit of a ceiling lately, and that says to us that we're not seeing any new buying coming into the market, and quite often a market that doesn't see new buying might actually engender a bit of selling, and we believe that a market that doesn't want to move higher will have to actually test what kind of buying support it can find at lower levels on a technical basis. So we may see that start to happen. We may see some profit taking. We may see some buying support for equity markets at lower levels if we see it. But the market will definitely want to test that support. So that's something that also keeps us cautious. When we're cautious, we carry larger than normal cash balances in our client portfolios. Cash is a defensive asset. We mentioned this before. We believe that patience is to be rewarded by giving us better opportunities and better values down the road. So I think it is said that being patient, being cautious at the moment, given the run in equity prices over the last number of years, I think we feel comfortable having a bit more of a defensive stance in our client portfolio. Paul, any further thoughts that you'd like to bring?
No, just to add that, as per your last comment, I mean, we're doing this for our money is invested alongside our clients, and we're doing this for our own family household money as well, and we're going to do the right thing for ourselves as well as our clients. We're cautious ourselves. Us and our clients are all going to be cautious. So our money is right alongside our clients.
Well said. Well said. Okay, and at this time, this is where we will turn it over to our clients. If anybody who's listening have any questions that they'd like to bring forward, we're more than happy to take them. So, any questions? No questions this week? Well, if there are questions from any of our listeners or any of our listeners who are listening to the recorded version, they have questions they want to get some answers to, there are our contact information there. Most of you will know how to get a hold of us. Please feel free to do so. Send us an email, pick up the phone. We're happy to have discussions at any time. So. But on that note, I'm going to say thank you to Paul, thank you to Bianca for joining me. Thank you to all our clients who've taken the time to out of their day to listen in, and thank you to all those who may be listening in to the recorded version. And I'm looking forward to hosting you all next week, and wishing you all a great week, a great long weekend to our Canadian listeners, and we'll be back next week, same time, same channel, and look forward to hosting you all. Thanks so much.